The stock market just hit a record high, 9 consecutive weeks of gains. Oil dropped to $87 a barrel, and investors are celebrating a ceasefire between the US and Iran. But here's the part worth paying attention to. Professional traders are not celebrating. They are hedging, and they have a very specific reason why. This week, Piper Sandler released a note saying the Strait of Hormuz could remain closed for months. Not days, months. That is a very different message from what the stock market is pricing in right now. So today we're going to talk about what is actually happening, why this matters beyond the headlines, and what it could mean for your money at every income level. Let us start with the basics. Most people have heard the phrase Strait of Hormuz. Few understand what it actually controls. The strait is a narrow waterway. It sits between Iran and the Arabian Peninsula, and it is the single most important oil choke point on Earth. Roughly 20% of the world's daily oil supply passes through it. That is not a rounding error. That is 1 in every 5 barrels of oil the planet consumes every day. When that waterway is open, global energy markets function normally. When it gets disrupted, the entire supply chain feels it. Not just at the gas pump, in grocery stores, in shipping costs, in manufacturing prices. The shock travels fast and wide. Now, for weeks, markets have been watching the situation anxiously. The strait had been at least partially disrupted by the US-Iran standoff. Oil prices climbed, supply chains tightened again, and then the ceasefire news arrived. Markets erupted upward. The S&P 500 locked in its 9th straight weekly gain. Oil fell back. Bond markets stabilized. It felt like the coast was clear. But hold that thought. Here is where things get more complicated. The ceasefire announcement generated real optimism. That optimism is not irrational. A genuine, durable reopening of the strait would be enormously positive for global growth. Lower oil prices cool inflation. They reduce input costs for businesses. They ease pressure on household budgets. They give central banks more flexibility. That is why markets responded so strongly. But seasoned energy traders are looking at the situation differently. Piper Sandler's analysts are not alone in their skepticism. CNBC reported this week that traders broadly doubt the Iran timeline. The reopening may be announced. Actual traffic recovery is another matter entirely. We have seen this before. Ceasefires get announced, the market rallies, then something disrupts the agreement, and the shock returns, often sharper than before. Edward Jones noted this week that we should wait for durable traffic recovery before assuming the crisis is fully resolved. That is measured, careful language from experienced analysts, and it deserves attention. So what does another potential oil disruption actually mean in practical terms? Let us make this real. When oil prices spike, the first thing most people notice is the pump. Fuel costs go up, but the effect does not stop there. Trucking costs go up. That means everything shipped by road gets more expensive, which is almost everything you buy. Airlines increase fares. Fertilizer prices rise because fertilizer is petroleum-based. That feeds into food prices. Heating and cooling costs climb. For a middle-income household already managing a tight budget, another oil shock is not an abstract problem. It is a real monthly pressure that compounds fast. And for investors, the implications branch in multiple directions. Energy stocks, companies that produce and refine oil, tend to benefit when prices rise. Sectors like consumer discretionary and transportation tend to suffer. Inflation-sensitive assets reprice, and the Federal Reserve's path gets complicated again. If oil stays elevated, inflation stays elevated. If inflation stays elevated, rate cuts get delayed. And delayed rate cuts matter for everything from mortgage rates to bond yields to growth stock valuations. This single choke point, one narrow waterway, has the ability to reshape the investing environment for the rest of 2026. If you enjoy breaking down markets and money, subscribe for future updates. Now let us look forward, because this is where the real opportunity and the real risk converge. The S&P 500 is already priced for an optimistic outcome. Morgan Stanley targets 8,000 on the index for this year. Goldman Sachs projects 7,600. Ed Yardeni, one of the most respected market analysts in the country, has called for 8,250. Those are ambitious targets. They are achievable, but they depend on a stable macro environment. And a stable macro environment depends heavily on energy prices behaving. If the Strait of Hormuz remains genuinely open and oil stays around or below $87, those targets look very reachable. Corporate earnings stay strong, AI spending continues to accelerate, consumer confidence holds. But if oil spikes back above $100, the calculus shifts. Earnings estimates come down, inflation reaccelerates, consumer spending gets squeezed. This is not doom and gloom, It is just honest probability thinking. And here is what that means for practical portfolio decisions right now. Energy exposure is worth revisiting, not because oil is guaranteed to spike, but because the risk of it spiking is being underpriced by a market in celebration mode. A small allocation to energy sector funds or energy-producing company stocks acts as a natural hedge. If oil rises, those positions benefit at the same time your other costs increase. It is not a perfect offset, but it provides balance. For investors in dividend-focused positions, this environment also rewards companies with strong cash flow and pricing power, companies that can pass rising costs onto customers without losing business. That is a very different profile from high-growth technology companies burning cash to fund expansion. There is also a broader lesson worth sitting with here. Markets are remarkably good at pricing in good news quickly. They are sometimes slower to price in the risk that good news does not last. 9 consecutive weekly gains in the S&P 500 reflects enormous investor optimism. That optimism is grounded in real data, strong earnings, AI investment, ceasefire hopes. None of that is manufactured, but the best investors also ask a different question. Not just what does the market believe right now, but what happens if the market is wrong. If traders are right to be skeptical about the Strait of Hormuz timeline, markets could reprice sharply. The gap between what is expected and what actually happens is where risk lives. That is not a reason to panic. It is a reason to be deliberate. Review your energy exposure. Look at how concentrated your portfolio is in rate-sensitive growth stocks. Consider whether your investments are genuinely diversified across sectors, and make sure your household has enough financial buffer to absorb a few months of higher energy costs if this situation reverses. The market is telling one story right now. The oil traders are telling a slightly different one. Both cannot be fully right. What you do with that tension is up to you.